Right now, something very important is happening in the world of cryptocurrency, and it could shape the future of the entire crypto industry. The President of the United States, Donald Trump, has just publicly expressed frustration about delays in passing a major crypto market structure bill known as the Clarity Act. This situation is creating a lot of discussion across the financial world, the crypto industry, and even among political leaders. Many experts believe that the decisions being made right now could determine whether the United States becomes the global leader in digital assets or whether innovation moves to other countries like China. Today, we are going to break down exactly what is happening, what the key players are saying, and what this could mean for the future of crypto, blockchain technology, and investors around the world. Welcome back to We Are Cosmic. If you are new here, this is the channel where we break down the biggest developments in finance, cryptocurrency, and the global digital economy in a simple and easy way so everyone can understand what is really happening behind the headlines. My goal here is not just to give you news, but to help you understand the deeper meaning behind these events so you can make smarter decisions in the future. If you enjoy staying updated on crypto, blockchain innovation, and the financial markets, make sure you subscribe to the channel and join this growing community of forward-thinking investors and analysts. Now, before we go deeper into today's discussion, I want to hear from you. If you like staying up to date with the latest crypto developments and global financial news, type the letter X in the comment section below. It really helps the channel, it helps the community grow, and it also lets me know that you enjoy this type of real-time analysis. Also, let me know where you are watching from today, because this channel has viewers from all around the world, and it's always interesting to see how global the crypto community truly is. Now, let's talk about what just happened. Donald Trump recently made some very strong statements regarding the Clarity Act, which is a proposed bill designed to create clear regulations and structure for the cryptocurrency market in the United States. According to his comments, he believes that traditional banks may be slowing down or even trying to undermine progress on this legislation. Trump made it very clear that he does not want the banking industry to interfere with what he calls the United States' powerful crypto agenda. His concern is that if the government does not move quickly to create clear rules for digital assets, companies and innovation could move to other countries that are more welcoming to cryptocurrency. This is an important moment because regulatory clarity has been one of the biggest issues facing the crypto industry for many years. Large investors, technology companies, and financial institutions often say that they want clear rules before fully committing to blockchain technology and digital assets. Without those rules, companies sometimes feel uncertain about how to operate, and that uncertainty can slow down innovation and investment. This is why many people inside the crypto industry have been waiting for legislation like the Clarity Act for a very long time. At the same time, this debate is not just about cryptocurrency. It is also about the balance of power between traditional financial institutions and the new digital financial system that blockchain technology represents. On one side, you have the banking sector, which has dominated the financial world for decades. On the other side, you have a rapidly growing crypto industry that promises faster payments, more financial access, and new opportunities for investors. The outcome of this discussion could play a major role in determining how the financial system evolves over the next decade. And what makes this story even more interesting is that several key figures in the crypto industry have already started reacting to these developments, including Ripple's CEO Brad Garlinghouse and other financial leaders. Their responses suggest that this situation may be reaching a critical moment. In the next part, we are going to dive deeper into Trump's statements, what the Clarity Act actually aims to accomplish, and why so many people in the crypto community believe this legislation could change the future of the digital asset market. To understand why this situation is getting so much attention, we need to look more closely at what President Donald Trump actually said and why his comments are creating such a strong reaction across the financial and crypto industries. In his recent message, Trump made it very clear that he believes the banking sector should not interfere with the development of cryptocurrency legislation. According to him, the United States must move quickly to establish a clear market structure for digital assets if it wants to remain competitive in the global financial system. His warning was direct and simple. If the United States fails to support the crypto industry, that innovation and economic opportunity could easily move to other countries. Trump specifically mentioned concerns that banks might be attempting to weaken or delay the progress of crypto legislation, such as the Clarity Act. From his perspective, this is unacceptable because he believes the digital asset industry represents a major economic opportunity for the United States. He argued that Americans should have the ability to earn more from their money, and that new financial technologies can help achieve that goal. His comments also highlighted something many people in the crypto community have been saying for years, which is that traditional banks often benefit from the current financial system and may not always support innovations that could disrupt their business models. Another important part of Trump's message was his emphasis on global competition. He warned that if the United States does not move quickly to support the crypto industry, other countries will step in and take the lead. China was specifically mentioned as a potential competitor in the digital finance space. This is significant because many governments around the world are currently investing heavily in blockchain technology, digital payment systems, and new financial infrastructure. If American companies feel restricted by unclear regulations, they could choose to build their technology in other countries that offer more supportive environments. Trump also connected the Clarity Act to another piece of legislation known as the Genius Act. According to his statement, the Genius Act was an important first step toward making the United States the global center for cryptocurrency innovation. In his view, passing the Clarity Act is the next major step required to complete that mission. He described it as a critical piece of legislation that could help secure America's position as the leader in digital finance and blockchain technology. One of the strongest parts of Trump's statement focused on the relationship between banks and the crypto industry. He suggested that banks should not try to block or weaken crypto legislation, but instead work together with the digital asset sector to create a system that benefits everyone. His argument was that cooperation between traditional finance and the crypto industry would ultimately serve the best interests of the American people. By working together, both sectors could help build a stronger and more innovative financial system. These comments quickly attracted attention because they show that cryptocurrency is becoming an increasingly important topic in political and economic discussions. Just a few years ago, many politicians rarely talked about digital assets. Today, however, cryptocurrency regulation is becoming a central issue in debates about financial innovation, technology leadership, and economic growth. This shift shows how much the crypto industry has evolved from a small niche market into a major global financial sector. At the same time, Trump's message also reflects the growing frustration within the crypto community about how slowly regulatory progress has been moving. Many investors, developers, and blockchain companies have been waiting for clear rules for years. Without those rules, it can be difficult for businesses to plan long-term strategies or attract large institutional investments. This is one reason why discussions around the Clarity Act have become so important. What we are seeing right now is essentially a turning point. The debate is no longer about whether cryptocurrency will play a role in the future financial system. Instead, the real question is how governments will regulate and integrate these technologies into existing financial structures. The decisions being made today could influence the direction of the entire digital asset industry for many years to come. As these statements from President Donald Trump began circulating across the financial world, reactions quickly started coming in from some of the most influential figures in the cryptocurrency industry. One of the most notable responses came from Brad Garlinghouse, the CEO of Ripple. Garlinghouse has been a strong advocate for clearer cryptocurrency regulations for many years, and he has frequently spoken about the need for governments to create frameworks that allow innovation while still protecting investors. When he responded to the president's comments, his message was very direct and supportive of the idea that the crypto industry needs regulatory clarity as soon as possible. Garlinghouse described Trump's message as extremely pointed, meaning that it was very clear who the message was directed toward. In his view, the statement was aimed at those policymakers and institutions that may be slowing down progress on crypto legislation. He emphasized that this debate has always been about what is in the best interest of the American people. From his perspective, creating clear regulations is not just about helping crypto companies. It is also about supporting economic growth, technological innovation, and maintaining the country's leadership in the global financial system. The involvement of Ripple's leadership in this discussion is significant because Ripple has been one of the companies most affected by regulatory uncertainty in the United States for years. The company has been involved in legal and regulatory battles related to how digital assets should be classified and regulated. Because of that experience, Garlinghouse and other Ripple executives have consistently argued that the lack of clear rules creates unnecessary obstacles for innovation. When leaders like him speak about the importance of legislation such as the Clarity Act, they are drawing from years of first-hand experience dealing with regulatory challenges. At the same time, the reaction was not limited to executives within the crypto industry. Government officials and regulators also began sharing their opinions about the situation. The chairman of the Commodity Futures Trading Commission, commonly known as the CFTC, also expressed support for the idea that the Clarity Act needs to move forward. According to his comments, establishing a future-proof digital asset market structure is critical if the United States wants to remain competitive in financial innovation. This concept of a future-proof market structure is important because the financial world is evolving very quickly. Technologies such as blockchain, digital assets, decentralized finance, and tokenized financial products are creating entirely new ways for people to move money and invest in assets. Without clear regulations, governments risk falling behind the pace of technological change. By supporting legislation like the Clarity Act, regulators hope to create rules that can adapt to future developments rather than becoming outdated as technology continues to evolve. Another interesting aspect of the discussion came from members of the House Financial Services Committee. Some lawmakers are now encouraging the Senate to adopt the language of the Clarity Act that has already passed through the House. Their goal is to resolve ongoing disagreements related to stablecoins, particularly the issue of whether stablecoin holders should be able to earn yield on their holdings. This may sound like a technical detail, but it has become one of the central disagreements between the traditional banking sector and the crypto industry. Stablecoins are a very important part of the crypto ecosystem because they are designed to maintain a stable value, usually tied to traditional currencies like the US dollar. They are often used for trading, payments, and decentralized financial applications. The question of whether users should be allowed to earn yield on stablecoins is controversial because it touches on areas traditionally controlled by banks, such as savings accounts and interest-bearing deposits. Because of this, the stablecoin debate has become one of the biggest obstacles in passing comprehensive crypto legislation. Some financial institutions are concerned about how these new financial tools could compete with traditional banking products, while many in the crypto industry argue that innovation should not be restricted simply to protect older business models. This disagreement is one of the reasons why progress on the Clarity Act has been slower than many people expected. What is clear from these reactions is that the conversation around crypto regulation is reaching a critical stage. Industry leaders, regulators, and political figures are now openly discussing how the future financial system should be structured. The outcome of these discussions could determine whether the United States becomes the center of the digital asset economy or whether other countries take that leadership role. We will explore why so many people within the crypto community are becoming increasingly frustrated with the slow progress of these regulations and what this could mean for investors and the broader market moving forward. While the political statements and executive reactions are grabbing headlines, there is a growing sense of frustration within the cryptocurrency community, and it is easy to understand why. Many investors, developers, and enthusiasts have been following these regulatory developments for years, hoping for a clear path forward, but progress has often been slower than expected. Deadlines come and go, and proposed legislation frequently stalls due to disagreements between lawmakers, lobbying from banks, or debates over technical details like stablecoin yield. For those who live and work in the crypto industry, this slow pace can feel discouraging because it creates uncertainty that affects both innovation and investment decisions. One of the key reasons for this frustration is the sheer economic potential at stake. Cryptocurrency and blockchain technologies represent not just a new type of money, but a fundamental shift in how people can store, transfer, and grow wealth. Investors who have been patiently holding assets like Bitcoin, Ethereum, and XRP are waiting for the market to mature with solid regulatory support. Without clear rules, institutions and retail investors alike are hesitant to fully commit, which slows adoption and limits growth opportunities. For many in the crypto world, this is a pivotal moment, and any delay in clarity can feel like a lost opportunity for the United States to lead in this emerging global market. Part of the challenge comes from the complex relationship between traditional financial institutions and the crypto industry. Banks have built entire business models around existing regulations, and introducing innovative technologies like stablecoins, decentralized finance platforms, and blockchain-based payment systems can seem threatening to them. Because of this, some banks may lobby against legislation that empowers crypto companies or creates competition with traditional financial products. At the same time, the crypto industry argues that innovation should not be blocked just to protect established interests. This tension is at the heart of the current debates and is why statements from political leaders like President Trump are so significant. They signal that the government may actively intervene to prevent unnecessary obstruction. Another layer of complexity comes from the timing of these developments. For instance, the White House previously set a deadline to resolve the stablecoin yield dispute by the end of February, but that deadline came and went without a final decision. This kind of delay fuels the frustration because it leaves investors, developers, and companies in a state of uncertainty. Market participants cannot fully plan for the future, whether it's preparing for a bull run, launching new crypto products, or expanding services to global customers. Regulatory uncertainty, even if temporary, can directly impact both short-term and long-term growth in the market. At the same time, the crypto community is watching closely to see whether the pressure from high-profile figures like President Trump will actually accelerate progress. His statements are intended to motivate lawmakers and banks to move quickly and reach a deal that benefits both the industry and the American public. By framing the issue as one of national importance and economic competitiveness, Trump is attempting to raise the stakes and push for legislative action. From a strategic perspective, this kind of pressure can sometimes break through bureaucratic delays and force key players to compromise, but there are no guarantees. It is also important to consider the broader implications for investors and participants in the crypto market. Clear and timely regulation can bring several benefits. It can reduce legal risk, increase institutional participation, improve public confidence, and foster innovation in new financial products. Conversely, prolonged uncertainty can lead to market volatility, slow adoption of blockchain technologies, and encourage companies to seek more favorable conditions abroad. For anyone actively participating in the crypto space, understanding these regulatory dynamics is crucial for planning both investment and operational strategies. Finally, this frustration is compounded by the fact that cryptocurrency has grown into a mainstream financial asset. Millions of Americans and global investors now hold digital assets, and these investors are increasingly vocal about the need for clarity. Unlike traditional financial systems, the crypto ecosystem moves rapidly, and delays in legislation can have immediate, real-world consequences. This is why both the industry and the public are paying close attention to developments like the Clarity Act. The coming months could be decisive for the direction of the U.S. crypto market and the global leadership of digital assets. We will examine some specific policy proposals, what the Clarity Act aims to achieve in detail, and how these legislative changes could directly impact investors, blockchain companies, and the overall market. To fully appreciate the significance of the Clarity Act, it's important to understand what the legislation actually aims to accomplish and how it could reshape the cryptocurrency landscape in the United States. At its core, the Clarity Act is designed to create clear rules for the operation, trading, and regulation of digital assets, including cryptocurrencies and stablecoins. By establishing a formal market structure, the bill seeks to prevent confusion, reduce legal uncertainty, and provide investors and companies with the confidence they need to participate in the market without fear of unanticipated penalties or restrictions. This kind of clarity is critical because, until now, much of the cryptocurrency space has operated in a regulatory gray area, which can hinder innovation and slow the growth of new technologies. One of the major focuses of the Clarity Act is the treatment of stablecoins, which are cryptocurrencies pegged to traditional assets such as the US dollar. These assets play a key role in the crypto ecosystem because they allow investors to transact and store value without experiencing the volatility often associated with other cryptocurrencies. The Act addresses ongoing debates around whether stablecoin holders should earn yield, how stablecoins should be backed, and which regulatory body should oversee their issuance. These might seem like technical details, but they have real-world consequences for market participants. Clear rules on these issues can prevent disputes, reduce systemic risk, and encourage both retail and institutional investors to engage more confidently with digital assets. Beyond stablecoins, the Clarity Act also seeks to establish a framework for how other digital assets, such as utility tokens and security tokens, are categorized and regulated. This is particularly important because different types of tokens have historically been subject to conflicting interpretations under existing laws. For example, certain cryptocurrencies have been classified as securities in some contexts, but as commodities in others. This inconsistent treatment has created challenges for businesses trying to operate legally while innovating. By codifying clear standards, the Clarity Act could help companies plan their product development, attract investment, and operate across state lines without facing legal uncertainty. Another critical element of the Act is its emphasis on protecting investors while simultaneously encouraging innovation. The legislation recognizes that the crypto market is not only a speculative arena, but also a space where new financial technologies can create real economic value. By providing safeguards against fraud, ensuring transparency, and implementing fair trading rules, the Act aims to create an environment where innovation can flourish alongside responsible oversight. This balance is key to making the United States a competitive hub for blockchain technology and digital finance on the global stage. The Act also has broader economic and geopolitical implications. As President Trump mentioned, if the United States does not establish a strong regulatory framework, other countries, such as China, could attract the most innovative crypto companies and technologies. This is not just about investment dollars, it's about intellectual property, talent, and the future leadership of the digital economy. By passing legislation like the Clarity Act, the U.S. has an opportunity to solidify its position as a global leader, attract international investment, and create new opportunities for American entrepreneurs and developers. From an investor perspective, the Clarity Act could have immediate effects on market confidence and asset valuations. Knowing that there are clear rules reduces uncertainty and could encourage more people and institutions to invest in cryptocurrencies. This could increase liquidity, stabilize prices, and foster the development of more sophisticated financial products. For companies, Clarity allows for better strategic planning, from launching new tokens to expanding into new markets, without constantly worrying about regulatory challenges or legal disputes. Finally, the Act demonstrates a recognition that the crypto market is here to stay and that thoughtful regulation can coexist with innovation. By providing structure without stifling creativity, the Clarity Act represents a step toward mainstream acceptance of digital assets as a legitimate component of the financial system. For anyone involved in crypto, whether as an investor, developer, or enthusiast, understanding the specifics of this legislation is critical, because its passage could define the future trajectory of the U.S. crypto market for years to come. We will explore actionable insights for investors, potential market scenarios, and what this could mean for the future of Ripple, XRP, and other major digital assets in light of these regulatory developments. As we reach the final part of this breakdown, it's time to look at what all of this means for investors, the crypto market, and companies like Ripple, along with actionable insights you can take from these developments. The passage of legislation like the Clarity Act has the potential to create a more stable and predictable environment for cryptocurrency. For investors, this means reduced uncertainty, which can encourage both long-term holding and more confident market participation. When rules are clear, people are more likely to invest not just in individual coins like XRP, Bitcoin, or Ethereum, but also in the broader ecosystem, including blockchain startups, decentralized finance platforms, and institutional products. The clarity reduces the risk of sudden regulatory surprises that can lead to sharp market swings. For companies operating in the crypto space, including Ripple, a well-structured regulatory framework is equally important. Clear laws allow businesses to plan product launches, expand services, and attract investors without constantly worrying about legal pushback. In Ripple's case, the Clarity Act could help solidify the legal status of XRP, making it easier for financial institutions to adopt the token for payments and cross-border transfers. This kind of institutional adoption is a critical driver of long-term growth in both the price of the asset and the broader credibility of the crypto sector. When banks and regulators have clear guidelines, partnerships between traditional finance and crypto firms become more likely, fueling innovation and expanding market access. One actionable insight for investors is to monitor regulatory developments closely. The statements from President Trump, Ripple's CEO Brad Garlinghouse, and government officials show that political and legislative dynamics can have immediate effects on market sentiment. Even if legislation is not yet finalized, knowing how lawmakers and regulators are positioning themselves allows investors to anticipate potential market moves. For example, if the Clarity Act passes, we could see increased institutional investment, wider adoption of stablecoins, and more mainstream use of cryptocurrencies in payments and financial products. Being prepared for these changes allows investors to make informed decisions rather than reacting after the fact. Another important point is diversification. While legislation like the Clarity Act could benefit certain coins and platforms, it's important to understand that the crypto market is still volatile. Spreading investments across different assets, sectors, and use cases within crypto can reduce risk and maximize potential opportunities. For instance, alongside major assets like XRP and Bitcoin, investors might consider exposure to decentralized finance platforms, blockchain infrastructure projects, or regulated stablecoins that are directly impacted by legislative clarity. By taking a broader view, investors can capture growth across multiple areas of the ecosystem while remaining resilient to unexpected setbacks. It's also worth noting that the pace of regulatory progress matters. Deadlines like the ones previously set by the White House can influence market confidence. Delays in passing the Clarity Act may lead to frustration, but they also provide time to observe how stakeholders, including banks and legislators, respond under pressure. Tracking these responses is critical for understanding market sentiment and anticipating potential trends. Investors who stay informed and maintain a long-term perspective are better positioned to benefit when clarity eventually arrives.